So as far as kind of, if we know that that's what we think of the economy, what are the things that we need to consider as an investor? And ultimately, as kind of Tony already alluded to, when we think about, is it a great time to buy assets? The reality is the starting valuation matters a lot. And so this chart here shows the starting valuation for Australian equities. And it shows the earnings yield, which is the inverse of the PE, the price per earnings ratio. And what this shows is that you can generate a far higher return on shares than you can on a term deposit, on cash in the bank, or at an investment level on the 10-year bond yields. So it shows that from a valuation level, as Tony had said, because equities shares are cheaper, that they are attractively priced at the moment. So that's Australian shares. Global international shares are very kind of similar. So it is worth kind of knowing that shares were a lot cheaper through the sell-off, and then the market has started to recover. But ultimately, shares are still cheap, whether that's Australia or globally, kind of compared to your alternatives, which mainly is kind of term deposits and cash. The other kind of message that we always remind people of is, it's kind of hard to understand that why is the share market really going up and why is the share market rallying so quickly when every business we see, whether that be a restaurant, a pub, clubs, gyms, any kind of small business in Australia is really, really struggling. And the message that we have to remind people is the shares and the businesses that are listed on exchanges, and this is a US exchange, this is the NASDAQ, these businesses are very different to a small business that you may know in Australia. These businesses are of a high size. The businesses are extremely well capitalized, so they have very strong balance sheets. They have very strong competitive positions as well. Just so you know, like Apple is a business, I'm sure many of you have Apple products. Apple has $250 billion of cash sitting on its balance sheet. So extremely well capitalized businesses and very different to the average kind of small business that we see. And to us, that's one of the key reasons why the share market is rallying up now, while small businesses that you may see are struggling with that really soft economic activity. So those are the key slides I had. I'm just going to pass over to Lee Cronin now. Lee's going to talk through Australian equities and what we're seeing in Australian equities.
Thanks, Greg. What I thought I'd sort of touch on here is just sort of calibrating where the market's got in terms of their earnings expectations, and to sort of dovetail that back into what the RBA and others are thinking in terms of what stage we're at in terms of an economic recovery. So the top-down forecasts, or the forecast by the strategists at the large investment banks, are looking for, and this is initially in the US context, around a third reduction in earnings this calendar year versus last year. And to put some context around that, it was more significant than that during the GFC, more like 45%. Now, when you look at the bottom-up forecast, so essentially the analysts who are forecasting company by company, on an aggregate basis, in the US, they're looking for about a 20% decline in earnings this year and about a 29% recovery from that the following year. Now, the net of that, because 20% down, 20% up doesn't give you flat, the net of 22 down and 29 up the following year gets you calendar 21 earnings about 1% above what they were in calendar 19. Now in Australia, using the same sort of numbers, we're looking for about 20% down, similarly for this calendar year in terms of aggregate earnings. These are for listed companies within the ASX 200, but a more modest increase next year of more like 13%. Now again, we're not going to pretend that these numbers are going to be spot on, but directionally, this is where the market's sort of looking at. Now what that means is that in Australia, the expectation is that by the end of calendar 2021, we're still a bit behind what we were of last year. Now, again, reflecting back on the chart that Greg showed before, the RBA is expecting that GDP at an aggregate level for calendar 21 is about the same as what it was for calendar 2019. So again, you know, it's an event-driven recession. There's been a lot of monetary policy and fiscal policy thrown at this, you know, in the order of 10% of GDP, and we should see a reasonably rapid recovery from that downturn. If we go on to the next chart, well, we have seen a recovery in markets, as Greg alluded to. You know, March 23 looks like it was the low. You know, unless we have, you know, major second waves and so forth, which as Troy touched on earlier, we don't think we're going to get, you know, in a broad sense. I'm sure we'll have localized outbreaks and so forth, but less likely of having a major second wave, certainly here in Australia. The US market has picked up quite significantly from its lows. You know, it's about 30% up on its lows. That still leaves it about 10 to 15% lower than what it was in February. In Australia, we're sort of in the order of 20 to 25% lower than what we were in February this year before the downturn. Now that reflects the fact that we're making progress in terms of fighting the infection, or the infection rates are lowering. We're moving towards earlier than expected, perhaps reopenings within the economy, and we've seen a massive amount of monetary policy and fiscal stimulus thrown at that. And I guess the final point is markets tend to over amplify the effect of, or the negative effect of periods of downturn. As we sort of touched on, earnings may be down 20 to 30% this year. They won't be down 20 to 30% forever. They're more likely than not to be reverting to their prior trajectory within a year or so. But if you sit back and reflect, the long-term valuation effect of having 1 year of flat to down earnings, followed by a recovery over the course of the next 1 to 2 years, is in the order of 10 to maximum 20% effect on valuations. So when the market was down, you know, almost 40% from top to bottom, it was effectively assuming that earnings were going to be, well, you were going to have zero earnings or significantly lower earnings for a period, a much more extended period of sort of 3 to 5 years. And as the policy response has come in, and again, much quicker than what it did during the GFC, and as we're perhaps not seeing the worst fears come to pass in terms of the spread of infection, and the economy's perhaps opening a little bit earlier than what people thought, we're starting to see a recovery from the base there. We move on to the next chart. This last chart really is just to sort of highlight the sectors that have been more impacted on the way down, and the sort of sectors which have recovered a bit quicker on the way up. Energy, you've had very significantly lower oil prices, as well as the demand shock as we've gone into this sort of COVID shutdown. Financials, so it's mainly banks. You've had bad debt concerns. You've had dividend cuts and capital concerns, and low interest rates are just really bad for banks. They find it very hard to pass on lower cuts in or lower levels of interest rates. So they've been negatively impacted. They haven't really bounced much in the recovery as well. It's interesting, the banks in Australia represent about 20% of the ASX 200. They represent about a third of the total amount of dividend payments that are made to investors. So that they're then cutting or suspending their dividends, which they are at the moment, is obviously a real challenge for investors in the near term. We've got a more negative weighting towards the banks. You know, we'll watch it from a valuation perspective, but I think relying on the banks for dividends is a much different proposition going forward than what it was historically. I mean, what we're really suggesting to investors at the moment is, you know, I guess in summary, that the market's still 20 to 25% lower than what it is in February. That would seem to be, if we have a V or a Nike-shaped recovery, that would seem to be more than what the valuation effect is on those companies. There'll be some companies that will be more permanently impacted, but most companies will largely revert to a trajectory of growth. So it's a time to really focus on upgrading the quality of your portfolio, focus on the strength of the balance sheets and the quality of the underlying companies that you're investing in, with strong management that have sort of competitive advantages or strong moats around them. because at the end of the day, they will revert to a trajectory of growing earnings, and that means growing dividends, and that means compounding, value for investors over time. And that's certainly what we're focusing on at this time.